Okay, so let's unpack this.
Yeah.
I want you to just imagine a strategy where you literally do almost nothing.
Nothing.
Yeah, nothing. You ignore the terrifying news headlines about the next recession. You ignore the hot stock tips your Uber driver is giving you.
Right.
You ignore the panic on financial TV where everyone is like screaming at each other about interest rates. You essentially just sit on your hands.
It sounds a lot like you're describing apathy, or maybe just giving up entirely.
It does. It really does. But imagine that by doing that, by being like aggressively lazy,
Yeah.
you mathematically destroy the performance of people who spend 60 hours a week researching companies,
Okay.
reading charts, trying to beat the market, all of it.
It sounds like one of those late night infomercial scams, doesn't it?
Totally.
Make millions by sleeping. But what you're describing is actually the three-fund portfolio.
Hmm.
And we have a stack of sources here today that is honestly fascinating. We're looking at everything from these heated, almost philosophical debates on the Reddit Bogleheads forum.
Oh, they get intense.
They do. All the way to, technical white papers from Fidelity and even risk analysis from the North Dakota Securities Department.
Mm-hmm.
And they all kind of point to this being arguably the ultimate strategy for building wealth.
It's the lazy genius approach. And before we dive into the nuts and bolts, because we are absolutely going to get into the specific tickers, the tax loopholes, all of it, I have to say, if you are listening to this and you want to not just master your portfolio, but really master the psychology behind it, you need to subscribe to Money Mindset right now.
Absolutely.
Go hit that button. It's the best way to keep leveling up your financial game.
For sure. Because, as we were about to see in this deep dive, the math is the easy part.
Right.
Psychology.
Right.
That is where people lose money.
So our mission today is pretty specific. We aren't just looking at what stocks to buy. I mean, anyone can just give you a list of stocks.
Yeah.
We are looking at how to structure a portfolio that balances safety with, real growth. And we're specifically tailoring this conversation for that young adult demographic.
Yeah.
The people who have time on their side, but absolutely zero patience for complicated financial jargon.
Right. We're going to look at the philosophy, the execution, and the hidden traps. We've got breakdown data from GotTrade. We've got that risk analysis from North Dakota, and some really fascinating case studies from real investors who are arguing about this exact setup.
So let's start with the basics. The three-fund portfolio. It sounds too simple. I mean, 3 funds, that's it.
That is it. The whole concept comes from the philosophy of Jack Bogle, who, founded Vanguard.
The legend.
He is. If you don't know Bogle, he's essentially the patron saint of passive investing. His followers literally call themselves Bogleheads.
They do.
And they swear by the simplicity. The core idea is that instead of trying to pick the winning needle in the haystack, you just buy the whole haystack.
I love that analogy, buy the haystack, because trying to find that needle it's exhausting. You have to read balance sheets. You have to understand PE ratios.
Predict consumer trends.
Yeah.
It's a full-time job. It is exhausting. And statistically, it's a losing game. This all ties back to the efficient market hypothesis that gets mentioned in our sources. The idea is that all known information earnings reports, news, scandals, product launches, all of it is instantly priced into a stock's value by millions of traders.
Instantly.
So for you to beat the market, you have to know something that millions of other people don't.
Which, let's be honest, we don't. We aren't sitting in the boardrooms. We're getting the news at the exact same time as everyone else.
Exactly. We are reacting, not predicting. So instead of fighting that impossible battle, Bogle says, own everything. And the 3 components are usually these. Fund number 1 is a total U.S. stock market fund.
Okay, so what does total actually mean here? Are we just talking about the S&P 500? Because that's what everyone usually talks about.
That's a great question. The S&P 500 is just the 500 biggest companies, Apple, Microsoft, Amazon.
The big guys.
The big guys. A total market fund, like the ticker VTI, which comes up a lot in these discussions, it includes those giants, but it also has the mid-sized companies and the small-cap companies. We're talking exposure to thousands of companies, from the massive tech firms down to, smaller industrial companies you've never even heard of.
So it covers home base completely. If the U.S. economy grows, you grow with it.
Correct. Fund number 2 is a total international stock market fund.
Okay.
This is your exposure to the rest of the world. Europe, Asia, emerging markets. Tickers like VXUS are the common ones.
So this would cover things like Samsung in Korea or Nestle in Switzerland, maybe Alibaba in China.
Exactly.
Yeah.
And finally, fund number 3 is the total bond market. Tickers like BND. This is what provides the stability and income.
So U.S. stocks, international stocks, and bonds. That's the holy trinity.
That's it.
It's the irony of the whole thing. We grow up thinking that working hard means researching individual stocks, reading the charts, watching the news constantly. But this philosophy says that this lazy portfolio outperforms the complex, actively managed funds. And it's because you aren't paying high fees to a manager and you aren't making human errors based on emotion.
Precisely. The simplicity is the feature, it's not the bug. But, and here's where it gets really, really interesting. Just because the ingredients are simple doesn't mean the recipe is, non-controversial.
Oh, totally. We found this thread on the Our Bogleheads Reddit community that was it was a war zone. I didn't think people could get this angry about asset allocation.
It was really intense. People treat these ratios like a religion, and it makes sense, right? This is people's life savings we're talking about.
Okay, so let's set the scene for you listening. We have a user named Taguchi. They're 23 years old.
Quite young.
Right. And they want to start a 3-fund portfolio with those tickers we mentioned, VTI, VXUS, and BND. And they ask the golden question, what should be the splits?
And this is where the great allocation debate just kicks off. You immediately have a faction we can call the no bonds crew.
These guys are aggressive. They came out swinging.
Very aggressive.
Yeah.
Yeah. You had commenters like Imaginary Bottle and Chappie and Maya basically shouting that a 23-year-old has no business investing in bonds.
No business. That's such strong language. What's their argument? Why all the hate for bonds?
Well, their argument is purely mathematical. Bonds, historically, just have lower returns than stocks. Over the last century, stocks have averaged around, 10% annually, while bonds are significantly lower.
Right.
So bonds act as a drag on your growth, especially during bull markets. They're saying, unless you think bonds are going to outperform stocks for the next 40 years, which is, historically unlikely, a young person should just be 100% in equities.
There was that rule they mentioned, the 120 rule. Can you break that down for us?
Right. So the old rule of thumb, maybe what your parents used, was 100 minus your age is your stock percentage.
Okay.
So if you're 23, 100 minus 23 is 77. You'd be 77% stocks, 23% bonds.
Which feels pretty conservative for a 20-something. That's almost a quarter of your portfolio earning very little.
It is. But people are living longer now, and we need more growth to fund those longer retirements. So the new, more aggressive rule is 120 minus your age.
Which would put a 23-year-old at, what is that, 97% stocks?
Exactly, which is basically 100%. It's a purely aggressive stance. The logic is you have 40 years until you retire. You can ride out any crash. So why hold the safety asset if you don't need the money for 4 decades?
That makes perfect sense on paper. I mean, it looks great on a spreadsheet, but then you have the counter-argument, which I think is fascinating. It came from a user named Matt Schwink.
Ah, yes, the psychology argument.
Yes. Matt Schwink argues that asset allocation isn't just math, it's about your state of mind.
This is the critical piece that the Excel spreadsheet investors so often miss. It's easy to look at a chart of the Great Depression or the 2008 crash or even the 2020 COVID crash and say, oh, I would have just held through that.
Right, I would have been fine.
But living through it is completely different.
Yeah. When your account drops 40% in a month and the news is saying that capitalism is ending, can you actually handle it? Or do you panic?
That's the entire key. Bonds act as a shock absorber. Even if they lower your overall return slightly, they dampen the volatility. If your portfolio drops 40% and you panic and sell everything at the bottom because you can't sleep at night, well, you've just destroyed your wealth. You've locked in that loss forever.
So if having, say, 10% or 20% in bonds keeps the drop to only 25%, and that smaller drop prevents you from panic selling,
then the bonds were worth it. They aren't there for the returns. They are there to save you from yourself.
so they're insurance.
They are insurance against your own psychology. It's the price you pay to stay on the roller coaster.
That is such a crucial distinction. It's about ensuring you stay in the game, because the best strategy is the one you can actually stick with, not the one that technically yields the most money in some simulation.
Exactly. If you can't stick to 100% stocks during a crash, then 100% stocks is the wrong strategy for you, regardless of what the math says.
But the debate didn't stop at bonds. There was a huge fight about the international split, too. This is the whole home country bias debate.
Oh, the classic. The question is, how much of your stock portion should be U.S. versus international? And if you look at the last decade, I mean, the U.S. has crushed international markets. Tech stocks have just gone to the moon. So a lot of people say, why bother with international? Just buy America.
Right. Some people say 20% international is enough, just a little sprinkle, like seasoning on your portfolio.
But the sources, specifically Vanguard's own data cited by username Korean, they recommend something closer to 40%.
40%. That feels really high to a lot of people. Why so much?
It matches the global market cap. This is the buy the haystack philosophy again.
Yeah.
If you want to truly own the market, you have to look at the world market. The U.S. is big, but it's not everything. About 40% of the investable value of public companies is actually outside the U.S.
So if you only hold 20%, or zero, you are actively betting that the U.S. will continue to outperform the rest of the world forever.
Correct. And you have to remember, there have been entire decades where international beat the U.S. In the 2000s, for instance, U.S. stocks basically went nowhere. It was the lost decade.
Right.
But emerging markets boomed. If you were 100% U.S. back then, you were miserable. If you had that international exposure, you had growth. It's about not putting all your eggs in one country's basket. Geopolitics shift.
Empires rise and fall.
Exactly. The three-fund portfolio tries to be agnostic to all of that.
Which brings us to my favorite part of that whole Reddit thread, the Argentina example.
Yes, this was very specific.
So a user Glider5491 chimes in, and they say they avoid bonds and instead hold specific country ETFs, specifically ARGT and Argentina ETF. And why? Because Javier Milei is the president.
This is a perfect example of the exact opposite of the three-fund philosophy. The three-fund idea is set and forget. It's passive. It admits, I don't know what will happen.
Right.
Buying a country's ETF because you like the current president is active speculation.
It's betting on a politician, essentially.
Yeah, it is. And look, another user replied saying they are in Australia and wish they had a leader like that, and someone from England said the same. It just shows how political views can bleed into investing.
We all do it. We see a leader we like or a policy we like, and we think, oh, that's going to make money.
But from a strict boglehead perspective, betting on Argentina because of Milei is incredibly risky. What if his policies fail? What if the global market shifts? What if currency inflation wipes out any gains? The three-fund investor doesn't care who the president of Argentina is because they own a tiny piece of Argentina inside their total international fund anyway.
Right. If Argentina booms, the total international fund captures that. You own the winner automatically without having to bet on that specific horse.
Exactly. You don't have to be right about Milei. You just have to be in the market. That's the beauty of it. You profit from capitalism wherever it happens without needing to follow Argentinian politics on Twitter.
But let's say someone is listening to this and thinking, okay, I get the logic, I get the safety, but it sounds really boring.
It is boring. That's the point. Good investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 to Las Vegas.
But we crave excitement. We're human. We want to be part of the action. Is there any middle ground here?
There is. The God Trade source outlines a strategy they call core satellite.
Okay, break this down for me.
So think of it like a solar system. You have the core, which is the sun. This is the anchor. It should be, say, 60% to 90% of your portfolio. This is your boring, stable three-fund setup, broad market ETFs.
Vegetables.
The vegetables, the protein, the healthy stuff that keeps you alive. But then you have the satellite, the remaining 10% to 40%. This is the fun stuff.
The dessert.
Exactly. This is where you put your money for higher returns or specific themes or just to scratch the itch to trade. Maybe you want to buy that Argentina ETF. Maybe you want to bet on AI or clean energy or a specific individual stock you love like NVIDIA or Tesla. You do it in the satellite portion.
I see the psychological benefit here instantly. It separates stability from speculation.
Yes. It lets you chase a trend without risking your entire financial future. If your satellite crashes to zero, if your AI bet turns out to be a bubble, your core is still there, compounding away.
Right.
You haven't lost your retirement.
But there's a risk here too, isn't there? They mentioned drifting.
It's a huge risk. Let's say your fund bet on a tech stock goes up 300%. Suddenly your satellite isn't 10% of your portfolio anymore. It's 50%. You have unintentionally become a high-risk investor.
Because now half your money is tied up in one very volatile stock.
Exactly. You have to have the discipline to sell those gains, to sell the winner, and put them back into the boring core. And that's hard to do when you feel like a genius.
That's the hardest thing to do, selling the winner to buy the boring stuff. It feels completely wrong.
But that is what risk management is. It's rebalancing. If you don't rebalance, the satellite eventually becomes the core, and then you're just a gambler.
Okay, so we have the strategy, we have the philosophy. Now we need to talk about the vehicle itself. We've been throwing around the term ETF a lot. But a lot of people have mutual funds, especially in their 401ks. They sound the same, they both hold baskets of stocks. What is the actual difference?
This is critical, and the Fidelity and GoTrade sources break this down beautifully. Structurally, they are very, very different animals, even if they hold the same stocks inside.
Okay, start with the trading mechanism. How do they trade?
An ETF, an exchange-traded fund, it trades just like a stock. You can buy it at 10:00 a.m., you can sell at 10:05 a.m. The price changes every second based on supply and demand on the exchange.
And a mutual fund.
A mutual fund trades once a day. After the market closes, the fund calculates its net asset value, or NAV. They add up the value of all the stocks, divide by the number of shares, and that's the price you get. You can't trade it during lunch. You put in your order, and you just get the price at the end of the day.
That seems like a minor inconvenience. I mean, most long-term investors don't need to trade at 10:05 a.m. anyway. But there's a bigger issue here, right? A tax issue.
This is the secret sauce of ETFs, and Fidelity's source really highlights this. Mutual funds have a big tax efficiency problem.
Walk us through this. This is the part where people lose money without even realizing it.
Okay, so imagine you and I are both in a mutual fund, and I decide to sell my shares because I want to buy a boat.
Right.
The fund manager has to pay me cash. If they don't have enough cash sitting on hand, they have to sell some of the underlying stocks, say some Apple or Microsoft, to raise the money to pay me.
Okay, that makes sense. They sell assets to pay you out.
But if the manager sells those stocks at a profit, let's say they bought Apple 10 years ago and it was cheap, that sale triggers a capital gains tax event. And here is the kicker.
Yeah.
That tax bill is distributed to everyone still in the fund.
Wait, so even if I didn't sell anything, even if I'm just sitting there holding my investment, minding my own business, I could get a tax bill?
Yes. You could be holding your shares, doing absolutely nothing, and get a tax bill because I sold mine to buy a boat.
That sounds incredibly unfair.
It feels that way. It's called the capital gains distribution.
Yeah.
But ETFs, they generally avoid this. They use a special mechanism called in-kind creation and redemption.
Okay, unpack that. How does in-kind wash the taxes away?
It involves these things called authorized participants, think big institutions, banks, market makers. When they want to redeem shares of an ETF, say there's a lot of selling pressure, they don't usually exchange cash with the ETF manager. They exchange the actual basket of stocks.
So they're swapping the stocks for the ETF share directly, no cash involved.
Exactly. The ETF manager isn't selling the stock on the open market to raise cash. They're just handing the stock certificates to the authorized participant and saying, here, you take the Apple and Microsoft shares and you give us back the ETF shares.
And because no cash changed hands.
Because it's an in-kind trade stock for stock. It's not considered a taxable sale by the IRS in the same way. The ETF manager didn't realize a gain. They just moved inventory around.
So the capital gains aren't triggered for the other shareholders.
Generally, no. And this makes ETFs much, much more tax efficient for taxable accounts.
Yeah.
Now, if you're in a 401k or an IRA, it doesn't matter as much because those accounts are tax advantaged anyway.
Right.
But for a regular brokerage account, ETFs are usually the clear winner because you control when you pay taxes. You only pay when you sell.
That is a massive detail that I think most people completely miss. They just look at the expense ratio, but that tax drag on a mutual fund can be huge.
Speaking of expense ratios, we really need to look at the fine print. Section 5 of our dive here. The costs you see and the costs you don't see.
The MER, management expense ratio.
This is the sticker price. It's an annual percentage taken out of your assets.
Yeah.
In a passive index ETF like VTI, this should be tiny, like 0.03% or 0.04%.
Which means for every $10,000 you invest, they take, what, $3 or $4 a year?
Exactly. It's practically free. But if you look at some of these active mutual funds, you might see an MER of 1% or even 2%. That's $100 or $200 a year on that same $10,000. Over 30 years, that compounding difference is tens of thousands of dollars. You are paying for a luxury yacht for the fund manager, not for performance.
But there are hidden costs, too. The North Dakota Securities Department had a bulletin about this. The bid-ask spread.
This is the hidden tax on every single trade. Every ETF has two prices. The bid, which is what a buyer is willing to pay, and the ask, what a seller is willing to accept.
And they aren't the same number.
Never. The ask is always higher. Think of it like a currency exchange at the airport. They buy your euros for one price and they sell them for a higher price. The difference is their profit.
So if the bid is $59.50 and the ask is $60.
That 50 cents is the spread. If you buy at $60 and immediately turn around and try to sell at $59.50, you lost 50 cents instantly. You didn't lose it because the market moved. You lost it to the friction of the trade itself.
So if you're trading constantly or day trading these ETFs, that spread just eats you alive.
Exactly. Now, for highly liquid ETFs like VTI or SPY, the spread is usually pennies. It's negligible. But for some niche ETFs, maybe a small cap biotech ETF or that Argentina ETF we mentioned, the spread could be wide. It could be 1% or more. You start the race a few steps behind.
Another term that came up in the Wikipedia source was tracking error. What does that mean in plain English?
It's basically a measure of how good the copycat is. An index fund's entire job is to copy the index. If the S&P 500 goes up 10%, your S&P 500 ETF should go up 10%, minus that tiny fee.
Makes sense.
But sometimes it doesn't. Sometimes the index goes up 10% and the ETF only goes up 9.8%, or maybe goes up 10.2%. The difference is the tracking error.
Wait, if it goes up 10.2%, if it beats the index, isn't that a good thing?
You'd think so. But in the world of passive investing, no. If a passive fund is deviating from the index, even to the upside, it means the manager is doing something they shouldn't be. Maybe they're holding too much cash, or they're sampling the stocks incorrectly. You want a passive fund to be boringly accurate. High tracking error is a red flag that the fund is broken or taking risks you didn't sign up for. You are paying for precision, not surprises.
One more hazard from the prospectus discussion leveraged ETFs. I see these touted on social media all the time. 3x Bull S&P 500. Triple your gains.
Oh, these are so dangerous for the lazy genius strategy.
Mm.
Fidelity has a specific warning on these. They're designed for daily trading, use derivatives. And because of the math of how they reset every single day, if you hold them long term, you can actually lose money even if the underlying index goes up.
Seriously, the market goes up, but my 3x Bull ETF goes down. How is that even mathematically possible?
It's a concept called volatility decay. Let's do a quick math example. Say you have $100. The market drops 10% today. You're down to $90.
Yeah.
For you to get back to $100, the market needs to go up about 11% tomorrow.
Okay, because you're starting from a smaller base.
Now imagine a 3x leverage fund. The market drops 10%, so your fund drops 30%. You go from $100 to $70.
Ouch.
Now, the next day, the market goes up 10%, your fund goes up 30%, but 30% of $70 is only $21. So you end up at $91. You're still down nearly 10%, even though the market is theoretically back to where it started.
That is wild. The volatility itself eats the value.
Correct. Over weeks and months, that sideways chop just destroys the value of leveraged funds. They are tax inefficient and structurally dangerous for holding. Avoid them if you are a three-fund investor.
Okay, noted. Avoid the leverage. Stick to the vanilla stuff. So we know what to buy: total US, total international, total bond. We know what to avoid: high fees, leveraged funds. The final piece of the puzzle is execution. When do I buy? Do I wait for the dip? Do I wait for the election to be over?
The sources are unanimous here. Do not try to time the market. The strategy is dollar cost averaging, or DCA.
Which is just a fancy way of saying keep buying no matter what.
It means investing a fixed amount of money at regular intervals, regardless of the share price. $500 a month on the first. Every month, rain or shine.
And the math here is actually kind of cool because it flips the script on market crashes. It makes you almost look forward to them.
It does. When the market is down, share prices are lower. So your fixed $500 buys more shares. When the market is up and expensive, your $500 buys fewer shares.
So you automatically buy more when it's on sale and less when it's pricey. You don't have to think about it.
Exactly. You end up lowering your average cost per share over time compared to someone trying to guess when to jump in. If you wait for the perfect bottom, you'll usually miss it.
And the stock guy source points out the psychological benefit again. It always comes back to psychology.
It removes market timing risk,
Okay.
emotional risk. You don't have to sit there stressing, looking at the red arrows, asking, is this the bottom? Is this the top? You just let the system run. It forces discipline.
And automation is key here.
100%. Set up the auto transfer from your bank. If you have to manually log in and click buy every month, you will eventually hesitate. You'll see a scary news headline, maybe about an election or a war, and you'll say, oh, I'll just wait a week. And then you miss the rebound. Automation removes your brain from the equation.
And when it comes to investing, your brain is often your worst enemy.
It really is.
So to recap this deep dive, the three-fund portfolio is about accepting that you probably can't beat the market. So you join it. You use broad, low-cost ETFs, total US, total international, total bond to cover the entire globe. You decide on an asset allocation that lets you sleep at night, maybe using that 120 minus age rule as a starting point, but adjusting for your own panic threshold.
Right. And if you need that excitement, you use a core satellite approach so you don't blow up your main savings. You favor ETFs for the tax benefits and taxable accounts. You watch out for the bid-ask spreads on niche funds. And you automate the whole thing with dollar cost averaging.
It's the ultimate set it and forget it.
It really is. It's mathematically backed and psychologically resilient.
So here is the question I want to leave everyone with. If this strategy, this lazy, simple, three-fund strategy, beats the vast majority of professional active strategies over the long term, why is the financial industry so obsessed with complexity?
That is the multi-billion-dollar question, isn't it?
Is complexity just a product they sell to justify their fees? Is boring actually the ultimate financial hack that they don't want you to know about?
I think the sources we looked at today would suggest exactly that. Complexity is profitable for the salesman, but simplicity is what's profitable for the investor.
Something to mull over before you open your brokerage app next time. Thanks for listening to this deep dive. Don't forget to check out Money Mindset, and we'll catch you on the next one.
Stay curious.